Now, hey guys, on this video, I have 3 reasons why I believe strongly that the Fed should not cut rates. Not at this point. Not yet. Do not do it. Don't do it. Not yet. Right? Let's break down these 3 reasons why I say don't. The Fed should definitely not cut rates yet. I don't think they should cut rates now in the next meeting. I don't think they should cut rates at the following meeting. I think they need to wait and don't cut rates. Now, the Federal Reserve, guys, they've kept the Fed funds rate pretty steady at about for the last, 5 or 6 times they've met. 5 times in a row, I think they've met. They've kept them steady and haven't increased and haven't decreased them. Now, the current Fed funds rate stands at between 5.25% and 5.5%, which really is a 23-year high, okay? The Fed funds rate, that's at the highest it's been in 23 years. They've kept it right at that 5.25% to 5.5%. The reason they've kept them steady is because these policymakers, these Fed fund policymakers, they've been emphasizing how important it is that they're confident that inflation is on a sustainable path towards the 2% interest, 2% inflation, right? They want a target 2% inflation rate, right? And now, so we're clear, when I say policymakers, I'm not talking about lawmakers, right? The lawmakers for the country is Congress, but the policymakers for the Federal Reserve are the group, the committee that decides on whether or not they're going to decrease the Fed funds rate or increase the Fed funds rate, right? And the Fed funds rate, just so we're clear, is the rate that banks charge one another for overnight lending, right? And so when that Fed funds rate goes up, it goes up for us, right? Us regular, average Americans who want to borrow short-term money, right? Auto loans, credit cards, personal loans that we get from banks and things like that. Although the rates for all those go up when the Fed funds rate go up, and the rates for all those go down when the Fed funds rate is cut, right? But these policymakers for the Fed, they've sort of said, okay, we're not quite sure that we're really getting down to 2%. And we want to make sure that we really are heading towards or getting close to 2% year over year, right? Keep in mind, the Fed does not want 0% inflation. No, right? Because 0% inflation would imply that there's no growth in the economy itself, right? So the Fed wants some type of inflation because that's an indication that the economy is actually growing, right? And so they just want year over year inflation to be 2%, core or PCE core inflation to be at 2%, right? Now, we already have core inflation month over month under 2%, right? Just so you know, right? But there's a meeting coming up in a few weeks, and I don't think, me personally, I don't think the Fed should cut rates in the meeting coming up. And I certainly don't think they should cut rates even in the next one coming up in June. Just my opinion, and here's why. The first reason is this. Inflation is slightly up recently, right? If we look at the latest readings from CPI, core, and, there's a slight increase right now in inflation. So it's like inflation is being real sticky in certain areas, right? And so the Fed funds rate, when you cut them, that's by default inflationary. Right. So we have inflation slightly going up already. But if the Fed comes through and says we're going to cut those Fed funds rate from 5.25, between 5.25 and 5.5, we're going to cut it by, 100 basis points down to 4.25 to 4.5%. All that's going to do is spur people to go buy and purchase. And when people buy and purchase, then things go up in price. And you've just defeated your whole challenge of getting inflation down. So because of that, right, especially in those really potentially hard areas that we see right now, where it's been the stickiest, gas, rents for homes, right? Guys, have you looked at rental rates lately, right? When you look at, if you know anybody that's looking for a place to live and you've looked at rental rates in major cities, right, still crazy high, right, in a lot of places. So we're clear. When the Fed makes money cheaper to borrow, which is what cutting the rates would do, it would make money cheaper to borrow. It's going to incentivize people to go out and spend money. It's going to incentivize people to go buy stuff, right? Regular people, it's going to say, hey, we can go out and borrow money now because money is now cheaper to borrow, right? So we go out and get loans, and when people go get loans, guys, the spending goes higher and higher. Demand goes higher, and what happens to prices when demand goes higher? Because everybody's spending, prices will go up, right? So that's why cutting the rates is an inflationary measure. And so because it's inflationary and we haven't got a handle on some of those outliers, right? Not say outliers, but some of those things like housing and gas and some food prices, because we haven't got a handle on that just yet, and people are still feeling this pinch. Me personally, I say leave the Fed funds rate where it is. Don't touch it for a few more meetings. Right now, so the issue of higher inflation on certain areas is going to stick around longer and longer if they go cutting rates. Now, the second reason I don't believe the Fed should cut rates just yet is because typically stocks and the market, typically the rule of thumb is that when the Fed increases rates, the stock market usually goes down and reacts by going down a little bit, right? And it becomes a buying opportunity for us investors. But when the Fed cuts rates and slashes rates, it usually, the rule of thumb is that it results in a higher stock market, right? That's the rule of thumb. Sometimes it happens and the stock market is not affected at all. But a lot of times when they lower the rates, the stock market goes up, which means less buying opportunity to buy inexpensive stocks for us regular investors, right? So investors like when the stock market goes down because that's a buying opportunity, right? And those buying opportunities will cease if the Fed starts slashing rates, right? Because then the stock market will slightly go up, right? And we'll, as regular investors, we'll have to wait a little longer before we see those buying opportunities. Now, I'm not saying I want the stock market to tank. I don't want that to happen, right? But we'll lose buying opportunities as investors if the Fed starts slashing those rates. So, okay, so why do stocks go up when the Fed cuts the federal funds or the federal funds rate? When the Fed says we're going to cut interest rates, why does the stock market typically react upward? It's because lower interest rates incentivize borrowing, not just for us regular investors, but lower interest rates, Fed funds rate, also incentivizes borrowing for businesses. So businesses can begin to make investments in capital or investments in equipment, investments in, like I said, capital, real estate. They can start making more investments and other expansions to their business that will increase their stock prices. That's why when Fed funds rate gets cut, stock prices typically, by rule of thumb, go up slightly because of the growth and growth and growth. Again, inflationary. Guys, the third reason I say don't touch the rate just yet, don't do it, is the stock market is already slightly overpriced right now, guys. As we speak, there's a number of measures out there that measure whether or not the stock market is overpriced, right? Morningstar, you got the Buffett model, right? There's all these indicators that are out there that's saying, you know what, right now the stock market is slightly overvalued, right? Not a big bubble, but maybe a small bubble, right? If the Fed starts cutting rates and the stock market increases, like we said happens when the Fed cuts rates, the rule of thumb, then we have an even bigger overvaluation of the stocks, of this overall stock market, right? Right. But as we know, guys, as investors, right, a good bubble is just a soon-to-be opportunity for a big burst for us, right, who want to invest. But, guys, we've had more than, in the last, I think since October, last 5 or 6 months, we've had more than a 25% gain in the S&P 500. And the S&P 500 is a good measure to measure the overall stock market and stock market performance, right? 25% gain since, 5 months. That's huge, right? If you wonder whether or not the stock market is overpriced, just think about that, right? So the Fed is going to meet again in a few weeks. And, the stock market has already priced in that there's almost no chance at this point that the Fed is going to cut rates at their next meeting, right? But it has priced in about a 67, 68% chance that the Fed's going to cut rates at the following meeting, right, in June. And I personally don't think they should do it. I don't think right now is the right time to cut rates. Again, it's inflationary. Again, it's going to cause a shift in the market that's going to push the market even to be even more overvalued. I say don't do it. Hey guys, listen, those are my 3 reasons why I believe that the Federal Reserve should not cut rates just yet. I say don't do it. Hey, listen, if you got anything at all out of this quick video, do me a favor, smash the like button, share the link, share the video with your friends, your network of people. And also, if you're not a subscriber, please consider subscribing to this channel. Hey, as I always say, the best person who's going to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.